Before we start talking about the cash securitization, I would like just to do a recap related to the synthetic securitization. So, in the last lesson we have understood how the synthetic securitization works and which are the benefits for the originator bank and for the investor in relation to this transaction. As you remember, we have talked about the regulatory capital relief, and we have seen that if we suppose that the object of the securitization is a portfolio of corporate loan, the originator bank can have a huge relief of regulatory capital after the securitization has been done by the fact that we can assume that the super senior tranche, which is the less risky part of the transaction, absorb a 20% risk weighting factor due to the fact that this kind of risk is securitized by a credit default swap with a counterparty, which is a bank. So basically, for 19% of the portfolio, we have to apply a 20% risk weighting factor. Then, in relation to the mezzanine and the equity risk, we have seen two alternatives. The first one is related to the fact that the equity tranche has been sold to the market. And in that case, we have seen that due to the fact that the mezzanine and the equity risk of the portfolio is collateralized via government bonds, the risk weighting factor which applies is 0%. So we will have a 10% of the underlying portfolio which absorbs a 0% risk weighting factor. Whilst again, the 90% related to the super senior tranche absorb a 20% risk weighting factor. The second hypothesis is the one in which the equity tranche, as it usually happens, is retained by the originator bank. In that case, what we will have is the following. Again, for the 90% of the portfolio, we will adopt a 20% risk weighting factor since the guarantor is a bank. Then, for the 8.5% of the mezzanine risk, which is sold to the investors to credit-linked note, and which refers to the tranche which are rated from BB above, for that kind of risk, we will have a 0% risk weighting factor, because again, the securitization is collateralized by government bonds, whilst for the equity tranche, due to the fact that it's the riskiest portion of the portfolio and it's retained by the originator bank, what happens is that the capital is deducted 1-to-1. Meaning what? That €1 of equity tranche absorbs €1 of regulatory capital. So in this case, we will have 1.5% of absorbed capital. Again, 90% absorb a 20% risk weighting factor, 8.5%, which is the mezzanine portion of the portfolio, absorb a 0% risk weighting factor because the collateral basically comprises government bonds, whilst the riskiest part, which is the equity tranche, basically is deducted entirely 1-to-1. Now, we have also seen that basically we can ideally decompose the portfolio in three portions of risk: equity, mezzanine, and super senior. The equity tranche is usually not rated, and again, usually is retained by the originator bank. The mezzanine tranche has got different rating. In this case, we got BB rating, single A, AA, and AAA. And the super senior tranche is considered the less risky part of the portfolio, and for example, according to the Moody's definition, they say that the super senior tranche is subject only to the catastrophic risk. That means that the bank which has sold protection under the credit default swap for the super senior tranche can be affected in terms of losses only if something, let's say, catastrophic happens in the market. In that case, that means that the net losses, i.e. losses net of the recovery rate, are higher than 10% of the portfolio, which is really usually a catastrophic hypothesis. Of course, due to the fact that the risk is different for each tranche we consider, also the return will be different. So the tranche which will pay the least coupon is the super senior tranche, whilst the tranche which will pay the highest coupon is, of course, the equity tranche. Now, there are three factors which affect the rating of the mezzanine tranches. The first one, which is the simplest, is the duration of the transaction, meaning that the higher is the maturity of the transaction, the riskier is the transaction, and that means that, for example, let's consider that in this kind of standard structure, the maturity is 5 years. So the rating agency, through their tranching models, what they are saying is that for a 5-year transaction, given all the other things being equal, we need to have 1.5% equity tranche in order to get a BB rating for that kind of note. Okay? If, consider all the other things being equal, we increase the duration of the transaction, for example, to 7 years, so 2 years more, the rating agency will need to have a higher equity tranche in order to get that BB rating. Meaning that, for example, for a transaction which is 7-year maturity, the equity tranche will be, for example, 2% instead of 1.5%. Is that okay? So, first factor which affects the rating in the tranching model of the rating agency is the maturity of the securitization. The second important factor is the credit quality of the underlying portfolio, of the portfolio of the originator bank, which is the object of the synthetic securitization. Which means that the higher is the credit quality of the underlying portfolio, the lesser will be the credit enhancement that, for example, the BB notes need to have that kind of rating. For example, let's suppose that this portfolio is a single A rated portfolio. And again, we have seen that we need to have 1.5% credit enhancement in order to get the BB rating. If, for instance, the portfolio is BBB rated, which is lower credit quality if compared to a single A rated portfolio, then what happens is that we will need, for example, to have 2% of equity tranche in order to get the BB rating for the tranche which is immediately, let's say, above the equity tranche. Of course, all the other things being equal. Okay? So, first factor is duration. Second factor is credit quality of the underlying portfolio. The third important factor when we assign rating to the tranches is the diversification of the underlying portfolio. Meaning, for example, how many industries are represented into that portfolio, or how many countries are represented into that portfolio. The higher is the diversification of the underlying portfolio, the lesser will be the credit enhancement that the BB rating needs to have in order to have that rating. For example, if we have a portfolio in which the underlying companies, so the corporate loans, are related only to 5 industries, and we have another portfolio in which the underlying corporate loans represent 10 industries, the second portfolio will need a lesser credit enhancement in order the BB to have that rating. Okay? So, duration, maturity of the transaction, credit quality of the underlying portfolio, and diversification of the underlying portfolio. These are the 3 most important factors in order to assign a rating to the tranches related to the synthetic securitization. You understand that the super senior tranche, you can observe immediately that is also the less risky part of the portfolio, because AAA investors of the notes will be affected in terms of loss before the super senior tranche, meaning that the AAA notes are subordinated in terms of risk, priority of payment, if compared to the super senior tranche of the portfolio. That means, if you think about that the implied rating of the super senior tranche is higher than AAA, because there will be some investor which bought the AAA tranche of the securitization, which will be affected in terms of losses before the bank which has sold protection under the super senior tranche. That means that the implied rating of the super senior tranche is higher than the AAA rating. In fact, usually the super senior tranche is considered to have like a AAA plus rating, even if officially this rating doesn't exist. So it will be rated officially single A, but in your mind you have to consider that this AAA rating is better than the AAA rating of the tranches which are below the super senior. Is that clear to everyone? One thing which is very important is that another name under which we can find the synthetic securitization defined is this one. CDO, Collateralized Debt Obligation. When you read something which is related to the CDO, you have to bear in mind that this is nothing else than a synthetic securitization. And usually it is called synthetic CDO. When you talk about a synthetic securitization, we have a synthetic CDO in mind, collateralized debt obligation. Synthetic CDO is nothing else but a synthetic securitization. Just before we talk about the cash securitization, I just want to remind you that there are a lot of reasons for which a synthetic CDO is arranged by the originator bank. What we have talked until now is basically a purpose for the originator bank which is related to like less consumption of regulatory capital. That is called balance sheet CDO. So, when the main purpose for which the transaction is set up is to have less regulatory capital absorbed, that is a balance sheet CDO. Balance sheet because it's related to a balance sheet purpose. But in the market, another significant CDO is called arbitrage CDO. This kind of CDO has got a different purpose for the originator bank. This kind of the purpose of this CDO is just to get an arbitrage profit. So all we have talked in now is related to a balance sheet CDO. So when you do a synthetic securitization, in order to have less regulatory capital absorbed after the transaction, but in the market, these transactions are also set up in order to realize an arbitrage profit. In that case, we are going to talk about an arbitrage synthetic CDO. Can you imagine how an originator bank can realize a profit by setting up an arbitrage synthetic CDO? Who can answer this? It's simple. No one can answer? It's very simple. Basically, when the return of the underlying portfolio is higher than the cost of the synthetic securitization. In that case, the originator bank, if the equity tranche is sold into the market, doesn't undertake any risk related to the originator portfolio, but it gets an arbitrage profit due to the fact that the cost of the synthetic securitization are less than the return of the portfolio. For example, if the portfolio return is, I don't know, let's say 1%, and the cost of the synthetic securitization are less than 1%, then the bank doesn't have any risk, but at the same time, it's got an arbitrage profit. Which are the costs of the synthetic securitization? That's very simple. The premium paid to the investor of the credit-linked note and the premium paid to the super senior bank under the credit default swap, and all the fixed costs which are related to the transaction, which will be rating agency, legal cost, setting up special purpose vehicle, etc. Okay? So if the whole cost of the transaction, which basically the most important component is the return paid to the investor, is less than the return of the portfolio, then you got an arbitrage profit. Because if you have sold also the equity tranche, the originator bank doesn't retain any risk at all, but it has originated an arbitrage profit. Now, I would like to talk about the cash securitization, then we go back to the synthetic securitization in order to compare the two structures better. Okay? We have seen 2 lessons ago, just briefly, how a cash securitization works. First of all, again, also here we can call a cash securitization Cash Cdo, Cash Collateralized Debt Obligation. Collateralized debt obligation is just the generic term to say that we got debt issued, which are the notes, which are collateralized by something, which is a portfolio. Then we got different names to better define the transaction. For example, if the transaction has got an underlying portfolio which comprises corporate loans, that will be called CLO, Collateralized Loan Obligation. Okay? For example, if the underlying portfolio comprises bonds, the transaction will be called CBO, Collateralized Bond Obligation. If the underlying portfolio comprises credit default swap, the transaction will be called CSO, which means Collateralized Swap Obligation, and so on. But in order to define generically all these transactions, we just call them CDO. Synthetic, if it's synthetic like the one we just explained, or cash CDO, or cash securitization, if we got the traditional form of the CDO. But the same applies. So if we got a portfolio of loan, we got a cash CLO. If we got a portfolio of bonds, we got a cash CBO. Okay? Now, if you remember how the transaction works, we just described the main guidelines 2 lessons ago. We can have a recap here. So, we got the originator bank. Under this transaction, the originator bank sells a portfolio of assets to a special purpose vehicle. So that's the big difference with the synthetic securitization. Means that here we got a real true sale, it's called true sale of asset under the cash securitization. So the assets are not anymore in the balance sheet of the originator bank. In order to finance the acquisition of the asset, the special purpose vehicle issues notes which are placed to the investor, which are called ABS, you remember, asset-backed securities. So, whilst in the synthetic securitization we got credit-linked notes placed to investor, in this case we've got asset-based securities. And if you remember, we have defined different categories of asset-based securities. You remember that? For example, if the underlying portfolio comprises residential mortgage loans, we got RMBS, residential mortgage-backed securities. If the portfolio comprises commercial mortgage loans, we got CMBS, commercial mortgage-based securities, and so on. The portfolio can have, I don't know, auto loans, motor loans, or, as you remember, future receivables. So cash flow, which are forecast to be obtained in the future by the originator bank. You remember that? Now, what is very important is the following. The traditional securitization, which is this one, is a kind of a bit more complex structure if compared to the synthetic securitization. That means that there are more players involved in the cash securitization than the ones we have in the synthetic securitization. Think about the synthetic securitization. We've got the originator bank, and then the counterparties which provide protection to the originator bank, which are the investor of the credit-linked note and the bank that sells protection under the super senior tranche. Okay? We can have additionally other players, for example, when we want to hedge the market risk of the collateral, the interest rate risk of the collateral. You remember, for example, usually all the synthetic securitization have got a swap counterparty which hedge the interest rate risk in favor of the investor of the credit-linked note, so that when the collateral is sold to pay the capital back to the investor of the credit-linked note, the investor of credit-linked note don't suffer any loss due to movement of the interest rate risk. Okay? So, or, for example, if the portfolio, I don't know, has got like different currencies, then you can have a cross-currency swap counterparty. But that's it. It's a very simple transaction. In fact, there are less costs involved in the synthetic securitization to set up the transaction, and also the cash flow of the synthetic securitization are very simple. Because you can imagine the only cash flow which is relevant is the premium which is paid by the originator bank to the special purpose vehicle or to the super senior bank, and the coupon paid by the special purpose vehicle to the investor of the credit-linked note. That's the only cash flow you've got there. Okay? Now, when we talk about the cash securitization, things are like a bit more complicated. Meaning that, due to the fact that we've got a true sale of assets, what will happen is that the risk of the underlying portfolio has been transferred to the investor of the asset-based securities, having the special purpose vehicle in the middle, as you remember, to segregate the risk of the originator bank from the risk of the underlying portfolio, as you remember. But the point is that also the cash flows of the underlying portfolio have to be transferred to the investor of the asset-based security through the use of the special purpose vehicle. And you can imagine that here we don't talk anymore about a single premium under a credit default swap, but we talk about what? We talk about a lot of cash flow that comes from the underlying portfolio and that have to be transferred to the investor of the asset-based securities. Because you remember that one of the risks in the cash securitization for the investor of the asset-based securities is that what? The return is not enough to pay the investor of the asset-based securities. So, who, under this transaction, who is in charge to basically have all these payments transferred to the investor when they are paid to the originator bank is the servicer of the transaction, of the securitization. The role of the servicer is to transfer in a precise way all the amount of cash flow that come from the underlying portfolio to the special purpose vehicle, and of course from the special purpose vehicle to the investor. So that's the servicer. Bear in mind that usually the servicer of the cash securitization is the originator bank. Okay? When you think about the cash securitization, bear in mind, for instance, that we are talking usually about, I don't know, residential mortgage-based securities. So we're talking about 100,000 of customers that basically have this kind of loans. And we're talking about that every customer is doing, I don't know, a monthly payment for his mortgage loans, and this monthly payment has to be transferred to the special purpose vehicle and to the investor. So you understand how many cash flow are involved in this transaction if compared to the synthetic securitization. So who is in charge to make sure that all the payments are transferred to the investors through the use of the special purpose vehicle is the servicer of the transaction. Then, another important actor is the swap counterparty. The swap counterparty has got the same role here if compared to the one under the synthetic securitization. But also bear in mind this. If, for example, usually the asset-based securities pay a floating coupon. You know what is a floating coupon? Like Euribor plus a spread. Fixed coupon is, I pay you, I don't know, 5% per annum, okay? Usually, all the asset-based securities are floaters. That means that the investor don't have the interest rate risk, correct? Because you know that. You, as an investor, you've got the interest rate risk only if the bond has got a fixed coupon. But if the bond is a floater, so it pays Euribor plus, I don't know, 50 basis points, you don't have the interest rate risk. Because as soon as the interest increases, also your coupon will be increased. Correct? So every time we talk about interest rate risk for bonds, you have to bear in mind that we're talking about fixed coupon. But that's natural. So, just to go back to the point, the asset-based security usually bear a floating coupon, so they are floater. Let's suppose that the underlying portfolio comprises fixed-rate mortgage loans. Okay? What could be the risk for the ABS investor? Louder, please. So what happened in that case?
I mean, if you receive, let's say, 4% fixed, and the Euribor becomes something like 5.
Yeah, but the investor have got a floating coupon. But?
Sorry, because you said that.
Yeah, but usually it's like that. But think about how this transaction works. No, it's a problem. You know what's the problem? You know, the main risk of the investor is that they don't have enough cash flow from the portfolio to get paid. So what happens? If the underlying portfolio is a fixed rate portfolio, like fixed rate mortgage loans, you know that when you do a mortgage loans, you can choose between variable rate and fixed rate. So for example, if you think that the rates will keep on like increasing in the next, I don't know, 10 years, which is the maturity of your loan, you say, you know what, I will have a fixed coupon. Otherwise, the other way around. Okay? So, if the underlying portfolio of residential mortgage loans has got like a fixed rate mortgage loans, that means that if the interest rate increase during the life of the securitization, could happen that there will not be so many cash flow in order to pay all the investor. Because the investor needs to be paid on the basis of what is the market condition of the interest rate, because they've got a floating rate notes. Whilst the portfolio is a fixed rate portfolio. So if the interest rate increase, what happens is that the ABS investor have to be paid more, but the cash flow could be not enough to pay this investor, because the underlying portfolio is a fixed rate mortgage loan portfolio. Is that clear? So, no, because the synthetic securitization, in the synthetic securitization, what you pay, what you get paid in terms of coupon is the premium under the credit default swap. Okay? So, you don't do the transaction unless it's an arbitrage transaction, but forget it for the time being. If it's a normal balance sheet synthetic CDO, so balance sheet synthetic securitization, you do that transaction even if it costs you more than the portfolio return. And why you do that? Because you need capital. So if you really need capital, the cost of capital for you, or the return of capital for you, could be higher than the return of the portfolio. So you are available, you want to pay more in terms of credit default swap premium than what is the return of the portfolio. So the return of the portfolio and the premium paid are not necessarily linked, because you have to consider that you do the transaction to relieve capital. Whilst here, you don't do for releasing capital, you just do for having cash flow. No, again, no. Because let's suppose that you've got corporate loans, whatever, even if they are fixed rate, and the rates increase, that doesn't affect the transaction. Because the bank will pay anyway, is committed to pay the premium under the credit default swap. Okay, unless the bank defaults, but that's another story. Okay? You know what I mean? Of course, the bank will have a loss in the balance sheet, like a normal loss. But, you know, if I give a fixed rate loan to a corporate name, and the rates increase, I've got a loss. But that is independent by the transaction. Here, the point is that the bank, the originator bank, sells the asset and is not anymore responsible of what happened to the asset. So the investor, when they buy the ABS, they have to think only about the composition of the asset. That's it. Once the assets are sold, you know, the originator bank is not anymore responsible. You know what I mean? It's different. Because the premium of the credit default swap doesn't change if the interest rate moves. Whilst the cash flow here changes and could change dramatically. Okay? So the swap counterparty under a cash securitization has got also the role of protecting the investor from the fact that, for example, the underlying portfolio of the securitization could be exposed to interest rate risk. Okay? The same is if the portfolio comprises different currencies. So in that case, we will have a cross-currency swap counterparty. So we have described the servicer, we have described the swap counterparties. Now we've got a new actor in this transaction, which is the liquidity provider. Who is the liquidity provider? The liquidity provider is a counterparty that is supposed to provide liquidity to the transaction in case something, let's say, dramatic happened to the market. Meaning, if, for example, for a certain period of time, which has to be very, very short, there are no cash flow for the investors of the asset-based securities, the liquidity line provider enters into the transaction, provides liquidity, which basically, for that kind of period of time, compensate the lack of cash flow to the investor. The only thing which is so important is that this has not to be related to the credit quality of the portfolio. It's only because of, like, or dramatic event or technical event. For example, let's suppose that the servicer doesn't do what he's supposed to do for a couple of months. So for a couple of months, the investors don't receive anymore the payment which they are supposed to receive because there is like a kind of fault in the servicer duties. Okay? So it's more a technical question than the fact that the portfolio basically becomes, let's say, bad in terms of credit quality. In that case, if it is just, you remember, a temporary lack of liquidity, so it has to be temporary, in that case, the liquidity line provider, the role of the liquidity line provider is to provide the cash flow that needs in that given period of time. Okay? Again, let's suppose that for 2 months, 3 months, so a short time, there is a lack of cash flow under the cash securitization. The role of the liquidity line provider is to provide this cash flow that temporarily miss under the transaction to the SPV and then, of course, through the SPV to the investor of the asset-based securities. Is that okay? Now, bear in mind one thing which is very important. Both for the swap counterparty and the liquidity provider, there are provisions in the cash securitization by which, if this counterparty gets downgraded, for example, usually is below single A rated, they have to be immediately substituted. Okay? So, for example, if the swap counterparty originally is a double A rated bank, the role you remember is just, to avoid interest rate risk for the ABS investor. And this counterparty, after 1 year, becomes, I don't know, a triple B rated bank, then usually the cash securitization has got provision in the documentation such that the swap counterparty has to be replaced by let's say, at least a single A swap counterparty. That is to keep the transaction like safe for the investor of the asset-based securities. So, as you just have seen, this transaction is a bit more complicated if compared to the synthetic securitization. First of all, we got the servicer, we got the liquidity line provider, we got swap counterparty, which has an additional role if compared to the synthetic securitization, and we've got also a trustee whose role is basically to make sure that every different aspect of the transaction are basically implemented properly. So there will be a board of directors under this trustee. This trustee has to check, for example, I don't know, that the servicer is behaving, let's say, good, that the swap counterparty has kept the original rating, all this kind of stuff. That the documentation has been sent timely to the investor of the asset-based security, that the reports about the situation of the portfolio are drafted in a precise way, all this kind of stuff. That's the role of the trustee, which is more an administrative role. Any question till now? No? Now, let's go more in details. Credit and answer. Let's see what is a credit enhancement. I want to see, that's this chart. We've got usually 4 different kind of credit enhancement in the transaction. You know what does it mean, credit enhancement? Improvement of the credit quality of the transaction for given ABS investor, which, just to do the synthesis, means if I invest in a AAA ABS, what is the amount of notes which are rated below BBB? Meaning, like we have seen before in the synthetic securitization, for the BB investor, BB tranche investor, the credit enhancement was 1.5%. Meaning that in order to affect, in terms of losses, the BB investor, you have to have losses in the portfolio higher than, net losses in the portfolio higher than 1.5%. Okay? Now, the first form, which is the most popular, the first form of credit enhancement, which is the most popular, is the creation of subordinated tranches. That means that, for example, you've got a structure for which This is the SPV. You got different tranche of asset-based securities, each one with a different rating. So the investor will invest in the AAA ABS, will be protected in terms of credit risk by the creation of subordinated tranches, meaning that below this AAA investment, there will be different tranches, each one with a different rating. So, in order to affect the investor of the AAA, you have to basically hit before him the AA, the BBB, the BB, and of course the first one who will be are the equity investor. Okay? So that's very simple. It's like in the synthetic securitization, the same kind of mechanism. Okay? Now, the second form is the excess spread. What does that mean? First of all, what is the excess spread of a cash securitization? The excess spread is the spread that remains into the transaction after the investor have been paid and all the fixed costs of the transaction have been paid. Okay? So let's suppose that the underlying portfolio has got a return of Euribor plus 1.5%, which is around 5%. You pay the fixed cost of the transaction, which are, you pay, so let's go back to this. You pay the swap counterparty, liquidity provider, the servicer, your lawyer, the rating agency, all the fixed costs. And then you pay who? The investor of the asset-based securities. And let's suppose that everything included cost 4.5%. That means that the return of the underlying portfolio net of the cost of the transaction is 50 basis points. That's the excess spread of the transaction. So, again, is return of assets portfolio minus fixed cost related to the structure minus return paid to ABS investors. What you can do is two things with excess spread. First of all, usually the excess spread of the transaction is for the benefit of the equity investor. So usually the equity investor, instead of receiving a coupon like Euribor plus X basis point, they receive the excess spread of the transaction. Okay? So, all the mezzanine tranches and the AAA, which is the most senior tranche in this transaction, are paid a given coupon, which is Euribor plus X basis point, where X basis point is proportionally linked to the rating of the tranche. So meaning that the higher is the rating, the less is the spread paid. Whilst the equity investor usually receive the excess spread. And you can imagine why. Because they retain the riskiest part of the transaction. The risk in the cash securitization is the risk that the cash flow are not enough to pay the investor. So, who has to undertake, first of all, this risk? The equity investor. Because if the cash flow suddenly are not enough to pay all the investor, the first one who will be affected will be the equity investor. So what will happen? You don't pay them anymore the excess spread. That's the reason why. Usually they get the excess spread and not a given spread over the risk-free rate, which is a floating rate notes, an ABS. Okay? So, what you do is basically, you can structure two different kinds of structure. The first one is called cash reserve account, or otherwise, you can just basically transfer the excess spread. I will explain you what does it mean. Okay, that's the normal case. Transfer of the excess spread. Meaning that if the cash flows coming from the underlying portfolio are not enough to pay all the investor, as we have said, the first one who will be affected are the equity investor. So what happens is the following. You take away the excess spread from them, and you start to basically transfer this excess spread to the other investor. So, let's suppose that the cash flow are not enough to pay. Let's suppose that the equity tranche is 3%, double B is 2%, triple B is 5%, 5%, and this is 85. Okay? Now look at that. Let's suppose that suddenly %1 of cash flow are not paid anymore. That will lead to, first of all, the equity investor. Okay? Then, if other cash flow will miss in the transaction, what you will do is just transfer this excess spread and put this in favor of the other investor. Okay? Meaning that the first one, which will be like the most protected investor, will be the AAA. Then the AA, then the single A, then the triple B, then the double B, blah, blah, blah. Okay? So basically, you take the excess spread and you start paying the other ABS investor, everyone according to the priority of payments, being the most protected, the AAA ABS investor. If the cash flow that means are like 5%, you don't pay, of course, the equity investor and the double B investor. Then the single A and so on. Okay? Otherwise, what you can do is saying that since the beginning of the transaction, you create a cash reserve account in which you put part of the excess spread on sometimes the overall excess spread. Meaning, in the example I've given you before, in which the return of the portfolio is 5%, the whole cost is 4.5%, the excess return, the excess spread is 50 basis points. You take half of this 50 basis points, let's suppose 25 basis points, and you put in an account which will be maintained until the maturity of the transaction. It's a segregated account. Okay? Every time you receive half of the excess spread, you put this half of the excess spread in the cash reserve account. Then, if at the end of the transaction, during the transaction, nothing happened, so the cash flow were enough to pay all the investors, you just close the reserve account and you give the money to the equity investor. Okay? Whilst, if something bad, let's say, happen, meaning that the cash flow are not enough to pay all the ABS investors, what you do is you withdraw money from the cash reserve account and you start to distribute this money to the investor of ABS, starting from the most senior, which is the AAA investor. One thing that maybe you have noticed, in the cash securitization, we don't have the super senior transaction. The most senior tranche is a AAA tranche, because this is a funded transaction, not a unfunded transaction like a synthetic securitization. So the name super senior tranche, you'll find that only in the synthetic securitization. Here, when we're talking about the most senior tranche, we're talking about the AAA tranche. Actually, even in the synthetic securitization, there is a funded part, isn't it? Which is the issue of the credit-linked note. You remember? But usually, in the synthetic securitization, that's only like the 10 or maximum 50% of the overall portfolio. Whilst here, the funded part is 100%. So if the portfolio is 100 euro, you issue 100 euro asset-based securities. In the synthetic securitization, if the underlying portfolio is 100 euro, the notional, you issue only 10 euro of credit-linked note, whilst 9 euro are transferred only via a credit default swap. Is that clear? No, it's not clear? Okay. Okay. In a synthetic securitization, out of 100 euro, let's say, of the underlying portfolio, the funded component, which is the part for which there are cash flow, is the one which is related to the issue of credit-linked note, which is usually related to what? Mezzanine and equity tranche, which usually are maximum 10-15% of the overall portfolio. You remember, in our standard structure, the super senior tranche was 90%. You remember that? So, meaning that the credit-linked note, the cash notes which are in the transaction are, let's say, 10%. 9% is only a credit default swap. Here, if you got an underlying portfolio for the originator bank of 100 euro, you got also 100 euro of asset-based securities, because there is no synthetic component, which is so important. I told you that my bank has done 45 billion of synthetic securitization since the beginning of 2006. Think about that. Can you imagine if these transactions were cash securitization? How can you place in the market 45 billion of notes? And only related to a bank. Then there will be other banks for 45 billion each one. You cannot do that. I mean, you don't find investor, because otherwise, I mean, it's impossible. So that's the reason why in synthetic securitization, you got 90%, which are transferred just through a credit default swap. So you don't need to have an offering circular, you don't need to place notes to the investor to find the investor. You just find one counterparty. In fact, the usual average size of the portfolio of synthetic securitization is, let's say, from 2 billion to 5 billion. Whilst in a cash securitization is from 300 million to maximum 1 billion, but maximum, let's say on average 400, 500 million. Which, by the way, if you think about that, if you got 45 billion overall securitization, you issue only 10% of these notes. And if you do 10 transactions, it's the same level as cash securitization in terms of notes issued. You understand this point? So, the second mechanism is the excess spread. We've got the third mechanism of creation of credit enhancement, which is the over-collateralization. Over-collateralization. What does it mean? I mean, it's not so often that you find this mechanism. The first one is, I mean, you find almost in all the transactions. The second one is very popular. You can find it, very often, the excess spread. But you can find both, actually. So you can find the first one plus the excess spread. This one, you can find only a few transactions. For example, the non-performing loans securitization. You can imagine what are the non-performing loans. Are loans that are non-performing. Meaning that, for example, you give a loan to a corporate and it doesn't pay interest, or it doesn't pay interest for a while, and pa. Meaning that these are distressed assets. And as you can imagine, distressed assets have got, yes, of course, a nominal value, a face value. But what is the real value of these assets? Less. No, zero. It depends upon what? Upon upon what will be the recovery rate. So, when you do a securitization of non-performing loans, which in Italy, until 4 years ago, was the main important securitization, like 35% of securitization were done on non-performing loan portfolio, so 1/3, which is a lot, now not anymore. What happened? In this transaction, if you want to securitize non-performing loan, okay, the notional of your portfolio will be 100. But can you think about that? Can you issue 100 euro of asset-based security out of 100 euro of non-performing loans portfolio? Can you do it or not? Yes or no? No, of course you cannot. Because meaning that the investor who buys the asset-based security, immediately they lose, 70%. So everyone, but maybe some of the AAA, will be affected by losses. So over-collateralization means that not only you have to compare what is the notional value of the transaction, but you have also to estimate what is the recovery value. So let's suppose that you've got 100 euro of non-performing loans portfolio, the recovery value is 30, you issue ABS for a notional of 20. You understand what I mean? Why you do 20? I mean less than the market value. Because so that the investor have got some kind of protection, some kind of credit enhancement. Because if the recovery value will not be 30, but will be like 25, and you have issued 30 euro of asset-based securities, you start immediately having losses. Whilst, in this stupid case I've done, you got 10 euro of credit enhancement. Meaning even if the recovery rate will be 25, you don't care, because the investor will get the capital at the maturity of the deal. That is called over-collateralization. When the value of the collateral, which you can think about that, is the underlying portfolio of the securitization, is higher than the value of the notes of the asset-based securities which are placed to the investor. Over-collateralization. When the investor starts suffering losses, when the recovery value will be less than 20, which is a notional of the asset-based securities issued within these non-performing loans securitization. And of course, who will be the first hit? The equity and blah, blah, blah. Okay? Fourth mechanism, which is not so popular, I mean, you can find it, but not so many times, is you see here, credit enhancer is basically it's a counterparty which enters into the transaction and which gives a financial guarantee to the underlying portfolio. So, for example, let's suppose that the cash flow are not enough to pay the investor. Who will supply the cash flow that the investor needs in the transaction? The credit enhancer. So you can see the difference between the credit enhancer and the liquidity line provider. Because the liquidity line provider has to intervene only if there is a temporarily lack of liquidity. So the lack of liquidity has to be temporary. Here, the credit enhancer is really a financial guarantor, meaning that the portfolio have got less cash flow than forecast. The financial guarantor has to put his money in order to pay the investor. So, in that case, in order the investor not to be paid, what will have to happen? The cash flows are not enough within the portfolio, which is the object of the securitization, plus the financial guarantor has to default. But this is not so often. Sometimes happen in US, but in Europe, never. I mean, never. Yeah, never in the normal transaction. Then, for example, you've got like government agencies that can be financial guarantor in some securitization which are risky but useful for the country. But it's not a normal player. But if you got an additional player, you see, in the context of the securitization. Okay.